Hello, everybody, and thank you so much for spending a few minutes of your afternoon here with us today. My name is Samantha Seguenza, and I am going to be moderating this presentation. You will see me throw some links into the chat that you might find useful. They will lead you to our full education center online, which is a whole library of all of our past recordings. You may find some value in that, as well as the link to book an appointment with an advisor after this presentation. Today's presentation is going to be speaking on value. We're going to be diving into value investing, which is especially crucial in high inflation periods like today. Our speaker today is going to be Michael Corgiat, and he will be speaking about how you can protect your assets and adapt to the ever-evolving market. But before I bring him on, I just wanted to remind you that although the retirement group has over 30 years experience working with both active and retired members of Fortune 500 companies, we are not affiliated nor endorsed by any specific company. The retirement group is a completely independent group of financial advisors, so please keep that in mind. I'd also like to let you know that after Michael's presentation, we will be answering some questions that have come in throughout the presentation. There is a Q&A box at the bottom of your Zoom window. If you find that you have a question throughout his presentation, please feel free to enter it. It's completely anonymous, and Michael will answer as many as he can before the end of his presentation. And with that, I think I can just introduce you to our speaker, Michael Corgiat. Michael.
Thank you, Sam, and I'd like to thank everyone for joining us today. My name is Michael Corgiat. I am one of the retirement-focused advisors here at the Retirement Group. We are a group of independent advisors that work with a number of Fortune 500 companies: AT&T, ExxonMobil, Chevron, Boeing, Caterpillar, Pfizer, just to name a few. As an independent advisory firm, we focus on working with individuals within these companies. We understand and know your benefits, much like the back of our hand. We've been working with folks at many of these companies for 10, 15, and 20 years. These on-demand webinars are just one of the many resources that we offer individuals. We also maintain a number of other resources. Those include our eBooks library, filled with books on all sorts of great subjects, like Social Security and estate planning, insurance planning, and even tax guidance and advice. We also have a newsletter and a blog. You can get your retirement-specific guide we have for many of the companies that we work for just by reaching out to our office and asking for it. We'd be happy to email it to you as well. And probably one of our most proud resources is our retirement cash flow analysis. We like to call it our Retire Kit. It's a complimentary service that we'd be happy to provide you as long as you're willing to provide us with some significant financial data along with your goals and objectives. It's a snapshot or a roadmap of your current financial situation, and it can give you an idea if you're on the right track for a comfortable, successful, and happy retirement, whenever that retirement might be, which could be a month from now, a year from now, 5 or 10 years from now. The sooner individuals start planning, the better off they're going to be when they do retire. I have seen that throughout my long career. The more planning and the sooner that you do it, the better off you're going to be. Why would you want to consider us here at the Retirement Group, besides everything I've already just talked about? I'm one of a team with more than 150 years of experience and knowledge and working with corporate employees. We have offices nationwide. I'm here in the Midwest with my partner, Patrick Ray, but I have clients all over the US of A. I already mentioned we've got a great knowledge on all your benefits, and I mentioned the complimentary financial analysis as well. Definitely want to take advantage of that. You can scan this QR code to follow us on our LinkedIn page. We keep an awful lot of resources on our LinkedIn page, including the ability to sign up for future webinars, as well as to see what the schedule is for our future webinars. Starting out with today's agenda, we're going to talk about value investing, but we want to go back, essentially, I'd like to say, for the past 3 years. A little more than 3 years ago, COVID came about, and this terrible virus scared us all, took the world by storm, and took a lot of lives, unfortunately. And as part of COVID, in the beginning, most governments, the country pretty much shut down. Business, 20 million people lost their jobs. And one of the things that happened was a significant amount of government spending. Our US government felt that they needed to pump a lot of money into the economy through things like the PPP program for businesses. Many individuals got those, I don't want to call them a tax refund. It was basically just a gift of $1,200 a couple of times. Tons of money, okay? Well, that money did a lot to help individuals there in the beginning. And I personally believe, and a lot do believe, that there was probably more spending that needed to be done. And one of the byproducts of all that spending was this terrible inflation that's been created. And now we're battling here as we speak today, along with higher tax rates, which inflation technically is a higher tax. And the fact that prices have gone up, we're paying more for goods and services across the board. Well, now we've got this terrible inflation. It peaked last summer at 9.1% core CPI. And the Federal Reserve finally realized, hey, we need to do something about this inflation. So we're going to start raising interest rates. Raising interest rates is their key tool to try and bring inflation under control. And essentially, the Federal Reserve can control interest rates, which is the short-term lending rate that they charge banks to borrow money from them. By raising those rates, it raises all interest rates, both for borrowing as well as savings. So there have been some pluses with higher interest rates. But the negative has been now the short-term interest rate is at 5 to 5.25%. So mortgages are above 7% now, auto loans at 6 to 7%. But you can get a CD, a 3-month CD now at 5%. So again, the pluses and the minuses. Another plus is these higher interest rates have begun to bring inflation under control. It is still higher than we are used to, but recently core CPI touched 5%, down from 6% a couple of months ago. So again, keeping all of this in mind, COVID and all the spending and the inflation that followed with interest rates, what are today's opportunities? Well, some of those opportunities have allowed us to capitalize on the market slowdown. Again, last year, amongst of other things, the stock market had a very bad year. Growth stocks were down 30%. The S&P 500 was down 20%. Value stocks were down less than 10%. And that's what we're going to talk about for a bit today. Is our philosophy is value-oriented investing in value stocks versus growth stocks. But the opportunity has been, listen, everything's on sale, including stocks in the stock market. Some stocks are at a significant discount, which are more growth-oriented stocks, and they offer a much wilder roller coaster ride with more volatility, whereas value stocks, and I'll explain here momentarily, value stocks were down, but they weren't down nearly as significantly because value stocks don't trade at high price to earnings ratios. So let's talk about that. Our philosophy, as I said, is value. We want to buy solid companies that are trading below their intrinsic value. Their underlying value or book value could be worth more than the value of the stock itself. We look for stocks and funds with low price to book and price to earnings ratios. High dividend yield. I love dividends. Value stocks offer the ability to get paid dividend income while you're waiting for the underlying stocks themselves to go up. All right. And we can help you identify great money managers, but you can do it yourself. One of our favorite value managers is Warren Buffett with Berkshire Hathaway. He is a tremendous value investor. He's more than outperformed the market in the 50 plus years that he's been an investment manager. And to this day, we use Berkshire stock in our value portfolio. It's one of our largest holdings. And he's one of the many great money managers long-term value managers. So let's talk a little bit about one, avoiding the permanent loss of capital, identifying a margin of safety, and reducing the downside risk. All right. 1 and 2 sort of tie together in that avoiding permanent loss of capital is, again, by identifying stocks that might be trading at $30 a share, but their intrinsic value is $40 a share, which means they have a margin of safety of $10 a share. They're underpriced. Why wouldn't you want to own a stock that it's underpriced versus overpriced? And a growth stock, the flip-flop could be the same $40 book value could be trading on a growth stock at $100 a share. Okay, there is no margin of safety in that stock. The only downside is the $60 per share difference between the book value of the stock and the price that the stock is currently trading at now. Okay, so those two, try to tie those two together. Value stocks versus growth stocks. You see here on this graph that value stocks, excuse me, have underperformed growth stocks over the past few years, but historically, they've done better in different periods of time, as this graph indicates here. On the upside, that's when growth stocks have outperformed value stocks, and on the lower side of the graph, value stocks have outperformed growth stocks, right? It's just been in the last several years where growth stocks historically have outperformed value stocks. And a quote from a very well-recognized value manager at Ariel Investments, Charlie Bobrinski, if you go back to 1926, value has beaten growth every 10-year period except the last 10 years. So there's a good chance that value could and potentially will outperform growth stocks over the next several years and even possibly the next decade. Something to keep in mind. Excuse me. Here's a simple example of a value philosophy in that buying a stock is like buying a small business. Here we've got a small flower delivery business that's for sale. The cost to buy the business is $200,000. The book value equals assets minus liability. Fortunately, this business has no debt. There's 5 delivery trucks worth $160,000 and an inventory that's valued at $10,000. So the total book value of this company is $170,000. The business owner is pulling a $30,000 net income a year from the business, and the owner can keep $24,000 of that. So what I see here is a 10+% rate of return on my investment. 24,000 over 200,000, that's better than a 10% rate of return. And it's a very simple business structure. Okay, so hopefully this helps to give you a better idea and a feel for the idea behind value investing. Now, I've talked about high government spending already, so let's dive into some of today's opportunities. All right, how do you want to capitalize on it? What makes you uncomfortable today in your overall long-term goals? How do we capitalize on opportunities today? Well, I've been doing this a long time, and I try to tell my clients over and over again, both new and existing, you've got to take advantage of the price volatilities in the marketplace. There's a lot of irrationality in the market, okay? I would like to, the old adage is buy low and sell high, all right? When you're investing, take a look at the underlying price to earnings and price to book of either individual stocks and or funds and ETFs to see, what makes more sense. High price to earnings stocks and funds are going to be a lot more volatile. And when the market is going like crazy, that's where there's a lot of irrationality in the market, okay? Don't get caught up in a herd behavior. And all that means is just don't follow everyone else, all right? Everyone else might be and could be piling into specific investments because that's what everybody else is doing, all right? You don't want to do that. you're better off to be patient and not greedy. And Warren Buffett lived by this adage. When everybody else in the world was greedy, Warren Buffett was patient, and vice versa. And you want to find managers that hold a lot of cash. Good value managers hold a lot of cash in their portfolios, including Berkshire Hathaway, looking for opportunities to buy stocks and/or companies that are on sale during times like these. So they're buying good assets on sale longer term, and that's why you want to find funds and stocks that have a lot of cash on hand. What is uncomfortable today? Well, to potentially decrease the risk, you need investments that are on sale. I've already talked about that. On sale items might cause you periods of discomfort. They definitely will. A good example here recently have been the financial stocks. Bank stocks have been beaten up in general overall. Now, there have been a couple of bad apples out there, a couple of companies or banks that have been taken over by the FDIC. One was recently auctioned off, and JP Morgan is basically taking over the remaining assets. But the financial sector is still a good investment. And the financial sector has been discounted because of this discomfort and, in general, the couple of bad apples. But talking about value sectors in general, I've mentioned financials, utilities, consumer discretionary, consumer cyclical stocks, as well as energy companies. These are all areas that are more value-oriented than versus growth-oriented, okay? And accepting this discomfort in order to enjoy a solid long-term growth in your portfolio is the best thing for you to do. I know it can be painful, all right? I tell my clients and new prospective clients all the time, now is the best time to be buying and making investments, especially with new cash, moving forward, because stocks are on sale. And it's one of the few things out there that is on sale right now. It certainly isn't anything at the grocery store, homes, or automobiles. Okay, so finally, just discussing some of our overall long-term goals. History has shown, if this is possible, the best time to retire is when stocks are on sale. So if you're considering retiring now or have retired in the last couple of years and you want to put money to work in the markets, now is a great time. Dividends. Again, I've already talked a little bit about dividends, but current dividends do pay more than the bond market, typically long-term, and dividends are a great way to help offset inflation because dividends help to offset increased prices. And finally, you've got to learn how to manage your emotions because you will be financially rewarded long-term. Keep your eye on the ball, stay focused, find good companies, find good stocks, invest in them for the long haul, make sure it's a diversified portfolio, and you will be rewarded long-term. And oh, by the way, when you're invested in value stocks, you're going to get paid while you're waiting for those securities to go up in value. And that's the dividends and interest income that you can receive. So make sure you've got a plan. Most Americans don't have a written plan. Take advantage of our retirement cash flow analysis. And all you've got to do is reach out to our office and we'd be happy to put one together for you. You can reach out for all of our resources by calling our office at 1-800-900-5867 or sending us an email if you'd rather not call at info@theretirementgroup.com. You could schedule a meeting by scanning the QR code here on the left with myself or one of my colleagues. And again, on the right, the QR code for our LinkedIn page. Definitely check it out. Go check our website out, theretirementgroup.com. We also have a YouTube page where we keep all of our recordings. So you could go in there and look for recordings that are specific to your company, which I think you'll find very valuable because we talk about companies' 401ks and companies' pension plans and other benefits. I think you'll really find it interesting by going to check that out as well. So I appreciate your attention, and I hope you got a little bit out of this presentation. I'm going to go ahead and turn the presentation back over to my colleague, Sam, to see what questions that we might have. Sam?
Thank you, Michael. Yeah, we got a few really great questions I want to make sure you answer before we end this webinar. The first is, why do value stocks tend to perform better than growth stocks during high inflation periods?
Well, that's a great question. Value stocks often have a higher proportion of their cash flow weighted in both in the near term. They're not looking out 5-10 years like a lot of growth companies are. It makes them less sensitive to the impact of inflation on the future value of money. They've got their money now. They're not expecting, like a lot of companies, expecting money in 5 or 10 years from now. So consequently, they're more likely to preserve their value, which allows them to outperform growth stocks that have future weighted cash flows. In other words, we're investing for now, not for the hope in the future. So I hope I helped answer that question. It was a good question.
All righty, thank you. Second one, how do value stocks' lower valuation multiples contribute to their performance during high inflation?
Another good question. Okay. Lower valuation multiples, which I mentioned during the presentation, price to earnings and price to book ratios, indicate that value stocks are trading at a discount. Okay. So a price to earnings ratio of 10 essentially means that a company could be earning $10 a share and its price is at $100. Just a hypothetical. That's a PE of 10 is a very conservative price to earnings ratio, considering that the S&P 500 is closer to 16. Well, Amazon is trading at 70. Microsoft is even trading at 35. Good companies, but trading at much higher multiples, okay? So in periods of high inflation, these stocks, value stocks, are more resilient due to their discounted prices, all right? They're on sale, and it enables them to provide better returns for investors who are seeking some refuge from the eroding effects of inflation.
All righty, and we have just one last one. How does the income generating nature of value stocks help during high inflation periods? Excuse me.
Good question. The income generating, that's the dividends. Value stocks often provide higher dividend yields or just dividend yields in general. Growth stocks typically don't provide any dividends, okay? So again, you're getting paid a dividend quarterly, possibly even monthly, while you're waiting for the value of your underlying investment to appreciate. It gives investors a steady stream of income. And in times of high inflation, that income really helps investors out. It also helps them to preserve their purchasing power by providing a hedge against the erosion of wealth caused by inflation, okay? So as a result, value stocks become more appealing to investors during these high inflationary periods because they've got all this cash on the books now. Their business is now versus not looking into the future. And again, I mentioned it earlier, but I'll say it again. I'm a huge fan of dividends. And that's, one of the biggest benefits of using value stocks. So thank you.
All righty, and that was all the questions.
Oh, great.
We'd like to thank you guys for joining us this afternoon. And again, if you if you would like to schedule an appointment with an advisor, please click one of the links in the webinar to schedule with one of the advisors. Thank you, Michael.
Thank you. Have a great day.
Bye-bye.